The Pennsylvania Mortgage Licensing Act requires all mortgage companies to purchase a surety bond before they can have their license issued. And if this is your first time getting licensed, you've probably never heard of a surety bond before. And if you're thinking of doing business in Pennsylvania, you probably want to know the mortgage surety bond requirements. And that's why in this short video, I'm going to help you understand what a surety bond is, why Pennsylvania requires the bond, how to purchase your bond and save hundreds of dollars, plus other helpful resources so you can get this process done. Real fast, before we get into the rest of the video, rather than say the Pennsylvania Department of Banking and Services, I'm just gonna say Pennsylvania to keep it easy. Finally, I know it doesn't sound like it's a big deal, but it would mean a lot to me if you get value from this video to hit that like button. It's gonna help this video and you'll be doing me a huge favor. All right, let's get into it and make sure that you're watching the right video. Who is required to get this bond? Pennsylvania licenses mortgage lenders, brokers, and servicers. Each license is independent, which means that it's going to have its own licensing requirements, including the bonding requirements. Just to really quickly recap, a mortgage lender, this is the company that's going to be responsible for actually writing the mortgage loan. A broker is going to be responsible for helping a customer find the right loan that's going to match their property goals and their financial goals. And then a mortgage servicer is a company that has a portfolio of mortgage loans that they're servicing on the day-to-day, collecting payments, issuing late payments, pretty much the day-to-day accounting of the portfolio they have. Every single license does require a surety bond, and there are going to be small tweaks to the amounts, as you'll see in just a moment. We'll go over the bonding options, the bond amounts, and the prices to purchase your bond. But first, let's talk about what is a mortgage surety bond. A surety bond, or in this case, a mortgage surety bond, is a legal contract that acts as a guarantee that you will follow both federal and state mortgage lending, brokerage, and servicing laws, follow your specific state licensing regulations, and service your customers with fair and ethical business practices. In short, this surety bond is the primary tool that your state and your customers are going to use to hold you accountable to the promises that you're making to them. It's for your customers' protection. So if it's a form of protection, what does a mortgage surety bond protect against? Pennsylvania has an actually pretty rigorous licensing process for all mortgage companies, and it includes steps such as ensuring they have the appropriate experience, owners have passed a criminal background check, identifying the qualified individual, they register that their business is legal, outline the business plan, among many other requirements. And despite these licensing requirements, every year there'll be a small handful of mortgage originators and mortgage companies that will purposefully and financially harm their customers so that they can make more money. Examples of these fraudulent actions can include things such as approving a borrower for a loan they can't afford to repay, helping a specific borrower get approved for a loan by providing false information, hindering other borrowers from getting approved by falsifying application information, pushing borrowers into loan products that are not appropriate for them to secure higher fees, creating false fees, among many other activities. This surety bond provides your customers with financial protection if they are harmed by these actions or similar actions. If they do fall victim to something like this, they can make a claim against your surety bond for financial compensation, but only up to the bond amount. And this is why the bond amount is so important. So let's talk about what is the bond amount. For lenders and brokers, the surety bond amount is going to be based on the total loan volume written in the previous 12 months. There are additional surety bond requirements for each license, and I'm going to cover those as we get to them. But before we go into it, check this timestamps because this is kind of a little bit relatively long section. I want you to be able to skip around to the license that matters to you. Let's get started with mortgage lending companies. Here are the tiers of loan volume with their corresponding bond amounts. 0 to below 30 million has a bond amount of 100,000. 30 million to below 100 million has a bond amount of 200,000. 100 million to below 250 million has a bond amount of 300,000, and anything over 250 million has a bond amount of 500,000. Mortgage lending companies must also purchase a fidelity bond in the amount of $300,000. A fidelity bond is just another type of surety bond, but this one protects against employee theft. So it's essentially going to safeguard customer funds from your employees in case they steal deposits or checks or sensitive customer information. And of course, we can help you get pricing for this bond requirement and also make sure that you get the bond issued. Mortgage broker companies. Here are the tiers of loan volumes with their corresponding bond amounts. 0 to below 15 million has a bond amount of $50,000. 15 million to below 30 million has a bond amount of $75,000. 30 million to below 50 million has a bond amount of $100,000, and anything over 50 million has a bond amount of $150,000. For mortgage broker companies, there is an additional bond. It's kind of optional. It really depends upon how you run your business. So this is a business decision. Here's how it works. If you take your fee before the loan that you're selling closes, you must purchase a bond in the amount of $100,000. And of course, we can get you pricing for this and help you get this bond. However, if you take your fees after the bond closes, you do not need to purchase this bond. And as you would imagine, this bond just ensures that you're going to follow through and get that loan closed for the customer. You're not going to take their fees and just disappear on them. Mortgage servicer companies. Mortgage servicer companies have a flat bond amount of $500,000. That's totally irregardless of the amount of loans you're servicing. There is one additional bond amount that's not really a Pennsylvania requirement. It's more of a federal requirement from Fannie Mae. It's another fidelity bond, and a fidelity bond, again, it's a special type of surety bond that protects against employee theft. This fidelity bond amount is going to be based on these factors: the total unpaid balance of single and multifamily originators, and the highest unpaid monthly total balance of loans that the servicer owns, including any loans that might be serviced by other companies. The minimum amount for this fidelity bond is $300,000. The actual bond amount that you may have to purchase is going to be based on a percentage rate of what we just kind of talked about in those bullet points. To make this easy, rather than rattle off a whole bunch of different things that's just confusing, click on the link in the description. It's going to take you to our Pennsylvania mortgage surety bond page. And on that page, I have a table that breaks out the percentage points, so you can kind of match up with what your percentage point should be and get the correct bond amount. And of course, we can help you get this bond, get you pricing for it, as well as get it written for you. That was a lot of information. Make sure you go look in the description at the timestamp so that you can go rewatch your specific license and what matters to you. The bond amounts, there's a lot of them, but it's really important because not only is it, again, the maximum financial protection afforded to your customers, but it's also going to affect the price that you pay. So let's start looking at how is a mortgage surety bond's price determined. Mortgage surety bonds are credit driven. This means that you're going to have to get a custom price based on a rate that's quoted from a surety. A surety is just the insurance company that just chooses to underwrite mortgage surety bonds, and every surety is going to be different. They're going to do their own independent analysis of the applicant, primarily based on these three factors: personal credit of the owner or owners, business and industry experience, prior bond claims if any of the owners have been licensed in the past. Based on these factors, the surety is going to quote a rate, and this rate multiplied by your specific bond amount is going to be the price that you pay. Because each surety does their own independent analysis, we've seen rates come in at differences of 1% to 2% plus more. And this is why you should work with Surety Bonds Direct or a specialized surety agency to get you pricing. You see, we work with the best A-rated sureties to price shop for you. So we're going to go look and collect all the different rates to try to find you the lowest one, which is going to be the lowest price. Let's look at an example so that you can see this with actual numbers. Let's use a bond amount of $100,000 for example pricing. Really pay attention to how 1 percentage point to 2 percentage point, even more, makes a huge difference in the ultimate price that you're going to pay. 0.5% rate costs $500. A 1% rate costs $1,000. A 2% rate costs $2,000. And a 3% rate costs $3,000. As you can see, based on your bond amount, getting a lower rate of 1 to 2% can make a huge difference and help save you thousands of dollars. And the money you save is money that you can put towards application fees, education fees, or exam fees, criminal background check fees. It's a lot of money potentially. And while example pricing is great, you can get your exact price today by going to the link I shared in the description and requesting a free quote. There's no cost to have us price shop for you. And once we get you pricing, there's absolutely no obligation to purchase. So this is free information that you can use to help get through the application process a little bit faster. What happens after you purchase your bond? Once you agree to a price, purchasing your bond is as simple as filling out an online checkout form. The minute your payment is processed, well, actually, before I even talk about that, I do want to stress that the payment is one payment for the entire bond term, which for most mortgage bonds is going to be 12 months. The minute your payment is processed, our issuance team will prepare your bond with the correct form, all the necessary signatures and seals, and the power of attorney. As you probably already know, the entire licensing process goes through the NMLS, the National Multi-State Licensing System. We're going to help you get the bond uploaded into the NMLS because it's electronically filed. There are a few steps that you have to do, but we have a whole outline of what to do. And if you ever get stuck, of course, we'll help you do it. Renewing your mortgage surety bond. As I alluded to earlier in the video, Pennsylvania has a bond term of 12 months from the purchase date or the effective date when you get your bond. This is another great reason to work with a specialized surety agency like Surety Bonds Direct because you get assigned your own bond specialist who's going to manage your bond for you. So as your expiration date approaches, they're going to call you 30 to 45 days in advance. Essentially, because your bond amount might change. Let's say if you are doing more mortgage volume, you might have to get a higher bond amount. Either way, they're going to have the pricing ready to go for you and make sure that your bond gets renewed on time. And that's the bonding process. It's really short. It only takes about 1 to 2 business days to complete from the moment you request your quote to actually getting your bond filed with the NMLS. Most states do have a mortgage surety bond requirement. So if you're getting licensed in any neighboring states, we can help you with that as well. If you have any questions about this process, ask in the comments. That's what I'm here for. I'll make sure I answer your question and get you the information that you need. Now, I know it doesn't seem like a big deal, but if you can hit that like button, if you got value from the video, it does make a big difference to me, and it helps helps YouTube show this video more, which is always great. Thank you for watching. Good luck getting licensed, and good luck in your business.